Welcome to the Keiser Report. I'm Max Keiser. You know, decades after World War II, a handful of Japanese soldiers held out on islands across the Pacific, refusing to surrender, or not even knowing to surrender. Today, several lost decades after Japanese financial equity and property markets collapsed, millions of salarymen also refused to surrender hope that one day their monthly allowance might actually increase. Alas, the average Japanese husband's monthly allowance has slumped to the lowest level since 1982. Yes, despite never-ending money printing by the Bank of Japan, salarymen and workers are still eagerly awaiting the dividends promised by Abenomics. Fight on, salaryman, fight on.
Yes, Max Keiser, the salaryman is the soldier who refuses to surrender in this financial war. I think they were inspired by Hiro Unoda, who didn't surrender for 29 years after the end of World War II. He was out in the Philippines until 1974, when he finally surrendered only when his superior officers told him to surrender. Now, in this financial war, the generals of the financial war are telling the soldiers, decades now after the financial war began in Japan, but now 5 years in the West, is keep on going, spend, 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 spend. And Japanese men's allowance at 1982 low as they await Abenomics. So salaryman's spending money, typically set by wives, managing family budgets, was 38,457 yen, which is $386, down 3% from last year and less than half the 1990 peak, according to Shinsei Bank. Now they're saying, of course, that this is remarkable because there's been so much money printing and Abenomics and the markets are booming and there should be a wealth effect, so the wives should be giving them more money, but they haven't.
Well, it brings up a couple of interesting... Yeah, that story about the Japanese man who didn't surrender, everyone knows the story. What they don't know is that he had discovered this cave full of sake. And actually, he was having a good old time. Now, you know, the Japanese housewives, of course, control the purse strings in Japan. The salarymen, the sake-imbibing salarymen, famously at the sushi bars after work, drowning their sorrows, they are really on allowance set by the Japanese housewife, the famous Mrs. Watanabe, who was also instrumental in determining key cross rates. Remember, during the collapse of Iceland, it was the Japanese housewife that was playing the Swiss franc over the Icelandic krona, etc. So the Japanese housewife is a key player in the global economics to levels I don't think many people understand. So this is really quite an interesting development.
Well, they have actually, the salaryman has, despite not seeing an increase in their allowance, they have increased their spending on beer by 21%. So they are allotting more money towards drinking. But Japanese salarymen don't have to be pessimistic. Their pocket money should gradually increase to reflect Japan's recovery, says Hiroshi Miyazaki, senior economist at Mitsubishi Morgan Stanley Securities in Tokyo, who he says he's the chief economist of Mitsubishi Morgan Stanley. And his own allowance has not been increased. But he says there's a recovery, but what there isn't a recovery, we're all sacrificing ourselves, we're kamikaze pilots in this financial war to these debts, these zombie banks that refuse to go away, and we're sacrificing ourselves to this ideal of these debts that cannot die.
Well, let me review again how this has all happened, because as you point out, there's a lot of money being printed. However, it's not trickling down to the salaryman in Japan or the worker here in the UK or any worker across the world. And this is why you see in Cairo and in Brazil people are rising up, because that money is not trickling down because of financial engineering, which has eliminated the role of the bond vigilante, the person who's supposed to be an active player in these markets, punishing the government for overspending and over money printing, has been neutralized by these quantitative easing programs by the central banks, who are now coordinating on a global level. So without any checks and balances, you have the continuation of asset prices going up in value, the top 1% of 1%, or the top basis point, as I call them, and the stagnation and social unrest of everyone else.
Now, you talk about the lack of a trickle-down effect, and this is what you're seeing in Japan, because here they're telling people that the average salaryman, that they should feel better because the stock prices are rising, the Nikkei is rising, and house prices are rising, at least around the world. And the Japanese yen has dramatically declined in the past few months. But wages fell, or were unchanged in 11 of 12 months through May, even as Japanese companies' stockpile of cash rose to a record, exceeding the size of Italy's economy, Bank of Japan data for the first quarter showed last month. So that's over $2 trillion sitting on Japanese corporations' balance sheets that's not trickling down. And it's not going to trickle down because the corporations are in a better position to know how much debts are still outstanding.
Let's put this in another context. Money printing to the West, to Bank of England, Bank of Japan, and Federal Reserve Bank in America is to those economies what oil is to OPEC. In the OPEC nations, because the oil is essentially controlled by the state, they don't need people to vote, they don't need people to work. The people live on a stipend in those countries. In America, in Japan, and in the UK, increasingly, people are living on a stipend set by the state who doesn't need them because they can print all the money they want to make themselves as rich as they want. Just like having an oil well, you pump the oil and you become a sheik and you come to London during the summer to escape the heat in the Mideast. If you're a JP Morgan banker or an HSBC banker, you print trillions of dollars and you live like a sheik at the expense of a thriving economy that is diversified in some way, that is affording people a decent middle-class lifestyle. And so that's why the people, the uprisings in Cairo, have a party of interest with Brazil and America and the UK at some point.
Now, of course, the way these generals in the financial war continue to fight this war is they take turns devaluing their currency because, of course, there's a global floating exchange rate. There's nothing to devalue against, so they devalue against each other for a quarter or two. It seems to be coordinated. And the pound sterling, for example, on Friday dropped by 1.2%, which is a huge move in the Forex markets. But then they take the next turn. So I think the salaryman also knows that they might as well just spend a little bit more on beer because it's only going to last a short term.
Well, whether it's beer in Japan or Prozac in America or whatever they do here in the UK, I don't know, sniff glue, it's all about getting high to null the effect of the financial terrorists.
Well, on the other side, here are the salarymen. They're the older guys. In Japan, you also have the younger guys, and this is the next headline here. Hikikomori, why are so many Japanese men refusing to leave their rooms? So, as we know, there's that huge swathe of youngsters up to actually the age of 50 now that just refuse to leave their bedrooms in Japan. And their parents take care of them because of the social stigma of throwing them out in the road. But the article connects it to the growth of the hikikomori to the phenomenon of the popping 1980s bubble and the onset of Japan's recession in the 1990s. It was at this point that the conveyor belt of good school grades leading to good university places leading to jobs for life broke down. A generation of Japanese were faced with the insecurity of short-term, part-time work. And this is when these youngsters, who were now no longer in a society of ever declining rates, because remember, rates have been flat in Japan for 20, 30 years. As Carl Denninger pointed out, this is basically just as bad as non-declining rates. So here you have these generation who is now considered parasites by the rest of society there. But there are no jobs. There's no way to leverage yourself up because rates aren't going down from where zero bound.
Well, this is why robotics are so strong in Japan, is that parents are creating robotic children and robotic pets because their own children are in their room, they refuse to come out, and their dogs and cats are killing themselves. So they're just creating robots. That's why it's so huge in Japan. So people have robotic children. The factory conveyor belt, as you mentioned, after World War II, Japan recovered by creating this enormous factory floor to the world, with something that China does now, but it used to be Japan. And they had to roboticize their minds as a result and roboticize their souls. And then when the factory broke, you just had a conveyor belt of teenagers fall off into this conveyor belt, face down into a kind of a pool of teriyaki. And they haven't been able to escape their origami and waiting for a tsunami.
But, you know, in terms of the global bond market, the bubble ending, the boom, the bull market that's been going on for 30 years in the West, this is over. And as Carl Denninger pointed out last week, the only thing we have to hope for, the best case scenario, is that rates stay at 0% for the next 30 years as they have in Japan. And this is what you're going to see, is salarymen hoping to God that they get a little few extra pennies for another pint of beer, or your youngsters with no hope of a future but servicing this debt, these student debts. They're going to be living in your bedroom and with their parents for decades.
Right. Well, as we say on the show, these low interest rate policies, they're sold to the people as a way to get out of deflation, but they cause deflation. They cause deflation, the low interest rates. They're causing the problems. The thing that must be done as soon as possible to rectify these economic woes is to start raising interest rates. Now, of course, the parasites who are speculating with real estate and other quote-unquote assets would get hurt. But they've already accumulated trillions and trillions of gains on their balance sheet, so they might lose, you know, a few bucks here and there. And of course, to them, that's the sign of the apocalypse. That's the sign that they themselves would start killing themselves if they lost a penny. If you go to Jamie Dimon and say, hey, Jamie, you just lost a nickel, he would whip out a gun and blow his head off. Because to him, that's the same thing, you know, as one of these other people losing their soul or losing their lives, you know, losing their joie de vivre.
Now, another nation where you see a lot of young men living with their families for many decades is Italy, and this is in the news as well, and regarding this financial war where you must sacrifice, somebody must sacrifice for the greater good. And in Italy, it appears to be small private businesses. Broke Italy would love to, but can't pay its bills this year. So in Italy, expenditures rose by 1.3%. Revenue, however, remained flat. And so the deficit rose to 7.3% of GDP, up from 6.6% last year. But they have a magical way to sort out their Maastricht Treaty requirements to keep the deficit under 3%. Basically, they have 120 billion euros that the government owes private contractors, and they haven't paid, and they can't pay because they just don't have the money, nor does the EU want them to have to sell bonds in order to pay off these private debts. And Flavio Zanonato, the economic development minister, says, I would love to pay the past due debts of the public administration by 2013, but I don't know if it can be done. It's not ill will, but there is a technical problem.
Well, they're going to default. Essentially, and that's, they're just dressing a default up as something other than a default, and default is where everyone's heading because there's no way that this Ponzi scheme of global economic fraud can continue.
Yeah, and just like the first story, you know, the generals of this financial war, this economic war, who are the heads of state, the heads of finances and treasury, they need to tell the people that basically the game's over. We all need to surrender because the debts can't be paid and they won't be repaid. So we need to hit reset, start over.
All right, Stacey Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Stay tuned for the second half, a whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Ian Williams of Charteris Treasury. Ian, welcome back to the Keiser Report.
Thank you.
Ian, let's talk about precious metals. You called for silver to get to $150 by December of 2015. Is this still the target? What's going on?
It is actually, yeah. I didn't quite expect it to come down this far. It's come back on the back of gold selling. Gold's come down on the back of some 500-ton liquidation from gold ETFs, mainly by North American investors. Most of that gold seems to have been bought by Asians, mainly in China and Thailand and out in the Far East.
So is there a transfer of gold from the west to the east?
Absolutely, yes.
Hundreds and hundreds of tons?
Yes.
What's the speculation now? How many tons does China own? Officially, they own 1,000 or so tons. What's the scuttlebutt? How many do they really own?
Well, that's the central bank ownership. Then you go, most of this buying recently has been by private individuals, which doesn't get counted in that. But I mean, with the costs that have escalated in the mining industry, if you were to find a new gold deposit today, if you borrow money and whatever and build a mine, you're probably talking $1,500 an ounce. So what's going on at the moment is that all these American ETF individuals are selling gold $300 below its replacement value, and the Chinese and most of the Asians are buying gold $300 below their replacement value. Well, guess who's going to win?
Let me ask you something. The replacement value, in other words, you're saying that the miners, their cost per ounce of gold is between $1,300 and $1,500 an ounce.
To build a new mine.
To build a new mine. Even now,
yeah.
the current mines, and I just read something recently, the cost of pulling gold out of the ground is now the cost is something around $1,100, $1,200, $1,300 an ounce.
Yeah, but some mines it's $600, $700. It depends on the mine because the infrastructure is already in place.
Has the cost been going up?
Yeah, because
How sharply has cost been mining? My point is this. The central banks are saying there's no inflation in the economy. They're pursuing deflation, policies to fight deflation. However, the cost of mining has gone up 100% at least over the past 5 or 6 years. So where's the deflation there? Shouldn't the cost, therefore, of mining be deflating if the central banks are truthful?
well, I think from here on it will be because it's a typical sort of boom-bust mentality. So during the expansion phase, the shareholders of these mining companies were egging the management growth at all costs. And they were all expanded at the same time, so they were all headhunting people, paying quite huge wages, paying up for equipment. So a lot of the cost escalation was due to that. What's happening now is a lot of these CEOs of the big mining companies have all been fired for basically wasting shareholders' money, and they've now been replaced by new people. And the first thing the new guy does is cancel all the marginal capex projects. So that investment cycle in mining is now going into reverse, which is actually going to be very favourable for the mining companies' free cash flow. But of course, it's going to potentially lead to shortages in the sort of 2016, 2017 onwards.
Okay, so gold is typically trades inverse with the dollar, and the dollar is now trading up. It's got a lot of strength. All the technical people that I'm looking at are saying dollar on a technical basis is very strong. On a fundamental basis, it's strong. So am I correct to assume that for this gold and silver rally to find some footing and to break out and start moving to the upside, it'll be concurrent with a dollar topping out? Is that
Not necessarily.
Not necessarily.
No, absolutely. Because if you look between the year 2000 and the year 2011, gold went up every single year, and it went up. It didn't matter what currency it was priced
Okay,
in.
so let's talk technical analysis for a second, because Charteris in your work is primarily technical.
Well, a lot of stuff.
A lot to do with technical analysis, and technical analysis would be, let's say, unlike fundamental analysis, where you're looking at the management, you're looking at the macroeconomic trends. Technical analysis looks at the price charts pretty exclusively to look at repetitions and chart patterns and this type
cycles
of
as well.
and cycles.
Yeah.
So in the case of silver, okay, here you have a chart. I'm not a chartist. I'm not a technical expert, but I think anyone looking at that chart would say this chart looks pretty awful. So how do you get to that $150 price target by the end of 2015? What technical patterns have you violated? There's usually some terminology that people bring in, whether it's a head and shoulders, reverse head and shoulders, a candlestick, breakout, something. Technically, give us some tech speak here.
Okay. Well, the main reason we think this is apart from the fundamentals, i.e. gold and silver effectively being below their replacement cost, on the technical side, the main reason we like silver so much is there's almost perfect 10.5 year cycle in silver that bottoms around the years ending in 2/3. So you had a major low in 72, a major low in 82, you had a major low in 93, so it was 10.5 years then, and another major low in 2002, and we think that the 2012, 2013 is the bottoming of the 10-year cycle. And a lot of the sell-off you've seen in the last 3-6 months, if you look at Elliott wave type stuff, where you've got your C wave, which is a capitulation sell-in wave, a lot of the stuff, the market's heavily oversold at the moment. All the technical indicators fit in with the cycle low, in that what you're seeing is whether the C wave traditionally just wipes out all the stale bulls. And then what you're left with is a complete clean sheet of paper, and then you're off again on the new bull run.
All right, so when you refer to an Elliott wave or C wave, again, it's a technical tool, technical analysis tool. And for some watching, they'll say, well, that doesn't sound really like you can buy into this type of forecasting. However, since so many people do, it can become a self-fulfilling prophecy, because there's a huge number of hedge funds out there that actually just look at technical analysis, and if they fall in and start buying according to that, then it happens. But I want to change gears for a second, because last time you were here, you called pretty much the top in the bond market.
Yes.
And that, of course, was quite prescient.
Yes.
The bonds topped out.
Yes.
And now where are we in the bond market?
Well, again, if you look at cycles, take the gilt market, for instance, there's a 30, 36-year cycle in the gilt market. That's now topped out. So you had 30 years of upswing in bonds, gilts and US Treasuries, and we're now potentially going to have 30 years of downswing. Now,
interest rates going higher now for at least, for
a sustained period of time.
A cyclical...
Yeah. Absolutely, yeah.
Now, all the tracker rates for mortgages in the UK, they'll be starting to be adjusted upwards every quarter now going forward. Because they're interest rate sensitive.
Yes, but the bond market, when you're talking about the bond market, we're really talking about 5-year bonds, 10-year bonds, 30-year bonds, 50-year bonds. Doesn't necessarily mean that overnight interest rates are going to move. They'll be the last to move. What will happen is all the yields further down the curve will all move up. And then at some stage, I don't know, next year or whenever, the Fed will get round to maybe raising interest rates and tapering off its QE program. But the first phase of this will be in the longer dated maturities. It won't necessarily mean that cash overnight deposits start raising.
If you had a tracker rate, what'd you get out of it?
Basically, you're going to look at whatever your mortgage basically comes off. You're going to be looking at higher financing charges when it's rolled over now, because some are fixed to 5 years, some are fixed to 10 years. There's so many different types of mortgages. I mean,
Okay, fair enough. Okay, let's move on to. Now, you in your latest newsletter, just to follow up on this bond theme, it's titled "Bonds: The $80 Trillion Gorilla in the Room." So, it's funny because the gold and silver markets have sold off, and there's a lot of talk about that. But if you compare it to the bond market sell-off, particularly last Friday, the dollar volume paper losses in these bond sell-offs eclipses whatever anyone lost in gold and silver by a factor of probably at least of 30 or more.
Well, that's correct. I mean, in size terms, you're comparing a mackerel to a whale. In terms of, you look at an average pension fund, they might have 50, 60, 70% in bonds. They might have 1% in gold. So even if gold were to halve, in terms of what it affects a traditional pension fund, it maybe knocks the overall fund by 0.3, 0.4 or something. If the bond market halves, it decimates the value of the entire fund. So the movement in the bonds is far more important. It's a miles bigger market. So any percentage losses there are going to, if it's $80 trillion bond market, which we think is the size of the market, if yields back up to their historic lows, because we're at 300-year lows at the moment, effectively someone somewhere loses $2.5 trillion. That's the magnitude of the losses that you're looking at in bonds. Well, you're not looking at that's. As I said, it's comparing a mackerel to a whale. There's nothing like that sort of money being lost in the gold market.
Right. People said that there was a bull market in gold it's over. However, less than 1% of global investable assets are in gold.
That's correct.
So that's not a bull market. Bull markets have a lot higher ownership characteristics. Where in bond market, of course, it's especially in the last few years during rates coming down, we've had a massive rush into bonds.
Yeah, that's the bubble. Yeah.
No, one might have 40, 50, 60% of their money in bonds.
Absolutely.
So a move like we've seen in the last week, you're talking about real pain.
Oh yeah, and this is only the start. There's going to be a lot more to come.
Now, 1994, there was a bond sell-off, pretty vicious.
Yes.
So you're looking for something of that magnitude or bigger?
Oh no, it's going to be. 94 was just like a six-week blowout. It was pretty painful. Long gilts went from 8% to 10% in 6 weeks, but it wasn't in exactly the same way that this pullback in gold. It was halfway up the ladder pullback. It wasn't the big bear market in bonds. It was just a pullback, because 8% is still quite good value, but it still didn't stop them going to 10%. And then what you had when that sell-off, that 6-week sell-off was over, the bull market resumed, and it didn't pick up. And I think this is what's happening in gold as well. You've had gold went up every year from 2000 to 2011. Every single year it went up. It's now had a big shakeout. We don't think this is the top in the bull market, because one of the boxes, as you rightly say, is participation in the market. If there's only a 1% participation rate, it's a box you tick that you haven't seen the top yet. So we think what you're now going to see in gold and silver is another multi-year bull market. It's a tremendous investment opportunity for anyone to sell bonds and buy precious metals and mining companies.
Right. For those people who watch the show regularly, as they know, we started recommending silver at $5 and gold at $400. So we've been really following this for quite some time. I want to spend the last minute or so just touching on the banks, because banks, of course, they are capitalized with bonds.
Yes.
And we just went through a huge banking crisis where
Yes.
the credit froze, the banks had to be bailed out. It triggered a massive transfer of wealth from the top 80% to the top 1/100th of 1%. You know, okay, so if the bond market's in a bear market now, banks therefore are.
Well, they're the major players in the bond market.
We can see another bank failure?
Well, obviously, if the bond market goes into reversal, more than one bank is going to suffer some quite severe losses if the market pulls back. And I would think that the ones that get it right, like Goldman's did in the 2008 crash, that get short will be in the minority, and the ones that end up owning these bonds will probably be in the majority. So pick any name out of the hat, but someone somewhere is going to take a bath.
All right, Ian Williams, thanks so much for being on the Keiser Report.
Okay.
Well, that's all the time we have for this episode of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Ian Williams of Charteris Treasury. If you'd like to get in touch, tweet us at Keiser Report. Till next time, Max Keiser saying bye, y'all.